Venu Krishna, Barclays head of U.S. equity-linked strategies, joins us now at Post 9. Thank you for being here. Can you explain the work that you've done on that and what it means for those sectors that we outlined?
Sure. I think the challenge with tariffs is generally that companies don't report their exports and imports.
Right.
So I think what we try to do is get macro data from the Bureau of Economic Analysis and the Census Bureau, and then try to percolate from there down to sectors and map it to S&P and figure out, how do you estimate the direct impact of earnings, right? And there are two legs to it. One is, what if we go and put the tariffs? So for example, more recently, 25% on Canada and Mexico. And then the second part is, what if they retaliate? Most likely they will, right? And so the combined effect of that is around 3.7%. And for example, if in the past we said, let's ignore fuel and oil-related commodities, right? Because our assumption was that Trump doesn't want oil prices to go up. If you do that, it shaves off, let's say, 50 basis points. So depending on what combination you're looking at, that number keeps changing constantly. Big picture, if we take a step back and say, what if we were putting 60% on China and 10% of the rest of the world, that impact on S&P will be well over 5%. So quite substantial in the context of, roughly 12% earnings growth is what we see this year.
So then why do you think the markets have been so sanguine today? Is that just an implicit expectation that these tariffs won't take effect, that the retaliatory tariffs won't matter? I mean, why do you think that the market's kind of seemingly looking through it?
Yeah, so two things. One is, so far, the whole debate has been, do you take him literally or do you take him seriously? And then last weekend, we said we have to take him both literally and seriously. A day later, then the market realized that maybe it's just a negotiating stance. So I think that is the big debate. But overall, though, to your point, my view is that the market has been overly optimistic in pricing Trump-related growth policies, which is, on taxes and deregulation, and less so on immigration and tariffs. So that's where we are. So ultimately, what matters is which wins out. Do they even out, or is growth better than the constraining elements of immigration and tariffs? The market seems to think so far that it's a growth side which has an edge. And we would agree, but I think it's a fine line.
Do you think that there are some indirect elements that equity investors should also be paying attention to, in that there are uncertainties surrounding, the macro environment right now as it pertains to tariffs and geopolitics that could influence things like investment? It could influence things like the way that they are, dealing with their own trading partners as corporations that could stunt their growth. Or, are these things as well that equity investors should be paying attention to?
Yeah, absolutely. For example, on tariffs, just to touch on it briefly, the point is, even we assume that 50% of the costs are passed over to consumers, and they eat 50% or distributed, right? So companies have a series of options to deal with it, so we don't know where the dust finally settles. But your question on what are the other big issues, I certainly think that where the 10-year rates are, that still remains critical. That, in turn, is a function of what the bond markets think about deficits, about the impact of tariffs and the impacts of immigration. And as you know, the term premium on 10 years has gone up quite significantly. Now, why that is relevant is that if you look at long-term data, then roughly around the 5% threshold, there's a very clear negative correlation between equities and where the treasury yields are. So in other words, we have been in a sweet spot thus far, where treasury yields rising is not a problem because growth is good, earnings are nominal, the Fed is vigilant, everything is good. But there's always a tipping point. And I think we are in the danger territory right now. And the immediate impact of that, it's literally felt through multiples first. And it starts with high multiple stocks, including big tech. And then it eventually percolates into the rest of the market. So I think this environment right now is one in which we are more confident on earnings, as you saw so far. Like this morning, we are past the mid-cycle, and earnings are pretty good. But I think where the danger lies is on the multiples. It can keep bleeding slowly and steadily, like it has. Big tech multiples have come down from 30 times at the beginning of the year to 28 times right now. A week ago, they were 29 times. So that is a slow risk which you need to keep an eye on.
If we're in danger territory, though, real quickly, is it okay if or would you recommend investors sell out of equities right now, or just?
Well, big picture, earnings are going to accelerate. right? So I think more than pull off, I think our view is that pay close attention to what you're paying in terms of multiples for what you're getting, right? To the extent that you can make a good balance of that, that's what's going to help.
All right. Thank you, Venu. Really appreciate your time.
Thank you.